Wheel Deal coming at you with another video of the Wheel Deal Academy, the triple income strategy. Doing a little series, guys. This will be on the playlist. There's 5 or 6 videos on it now. This will be number 6, 7, or 8, whichever one it is. But I want to talk specifically about the wheel strategy, everything that it's about. You know, the cash secured puts, the covered calls, all of it. I came across this article last night. Feels good to be back in town. We were in Houston for the last few days. And we got to get our learn on, guys. I want to give you guys different perspectives on the wheel strategy because you never know which one's going to be the one that makes the most sense for you. Now, I'm going to tell you what I like about this article, what I agree about with this article, maybe the things that I don't agree with, etc., and kind of give you all my own twist of the wheel strategy in a nutshell. Because I think the wheel strategy in and of itself is incomplete. That is why I have my channel. If you're new to the channel, my name is TJ. I'm the Wheel Deal. I sell puts and calls for a living. But the twist is I do it on the same stocks over and over and over again until I manufacture the win. What I mean by manufacturing the win, stay tuned. Let's get into the article, guys. The Wheel Deal explains. The wheel strategy explained. 3 things you must know. The wheel strategy, also known as the triple income strategy, is a consistent way to generate income on the stock market. The wheel combines trading options with stocks to outperform the classic buy and hold investment strategy. Now, what is the wheel strategy? The wheel option strategy is a method that combines the cash secured put and the covered call. The wheel strategy is a bullish trade, meaning it will make money if the stock you pick moves up. First step in the wheel strategy is cash secured puts, guys. So a cash secured put is an options trading strategy that allows you to purchase shares of a stock at a discount. When you sell a put option, you promise to buy 100 shares at the strike price of the put option you sold. In exchange for taking on that obligation to purchase shares, you receive a cash premium similar to a dividend. On this channel, you have heard me say over and over, it's like manufacturing a dividend. Covered calls. A covered call is an option strategy, trading strategy that allows you to get paid for premium for promising to sell your shares of stock. Instead of selling your shares on the open market, you can sell a covered call and receive an extra premium for selling your shares. Covered calls are also a fantastic hedge for your portfolio since they provide income when stocks decrease in price or stay flat. In addition, you can collect cash payments for options, premiums, and dividends if you sell a covered call on a stock that pays the dividends. Now, the wheel strategy explained, guys. The triple income strategy is composed of just 3 simple steps to follow. Regardless of your skill level, the wheel strategy is not complex and is a great way to generate income on the open market. Step number 1, guys, sell cash secured puts until you're assigned. To start the wheel option strategy, you must pick a stock you wouldn't mind owning and sell a cash secured put on it. Let's repeat that again, guys. To start the wheel option strategy, you must pick a stock you wouldn't mind owning and sell a cash secured put on it. Then continue selling puts until you get assigned the stock. If the option expires before you get assigned, simply sell another one. Another one what? Cash secured put. You do it over and over and over again until you get caught with your hand in the cookie jar, guys. You sell covered calls until you are assigned. Once you have 100 shares or more of the stock, you will sell covered calls on them until you get assigned again. When you get assigned on a covered call, the shares will automatically get removed from your account and you will keep the premium as income. And here it gives you a little chart. I'm going to pin this on the description and you guys will be able to reference this particular article. Then after that, guys, you restart the wheel strategy by selling another cash secured puts. Now that you have completed the wheel and have no shares in your account, you can repeat the same steps. The goal of the wheel strategy is to generate income from the options you're selling. Any capital gains you make from the stock are just a bonus. Spoiler alert, I don't agree with that. Let's repeat it. Let's read it again. Now that you have completed the wheel and have no shares in your account, you can repeat the same steps. The goal of the wheel strategy is to generate income from the options you're selling. Any capital gains you make from the stock are just a bonus. Caca. Don't believe it. The reason that I sell puts and calls for a living is to generate income to stay in the game long enough Those are the crumbs. The loaf is the share price appreciation. Make no mistake about it. You're going to make a lot more money buying stocks for $1 and selling them at $2 than you ever will by selling puts and calls and generating premiums. I don't know what the hell they're smoking. Don't buy that pot from that drug dealer. It's just not good information. Cash secured puts and covered calls are the same thing, essentially. Not really. As you can see in the risk diagrams above, there is no difference between a covered call and a cash secured put from a risk profile perspective. Buying 100 shares and selling a $50 strike call is the same as simply selling a $50 strike put. However, the wheel strategy is great because that is a systematic way to combine these two effective strategies. And then it goes on to give you an example, wheel strategy example. Let's say stock XYZ is trading at $100 per share. You're bullish on the stock and wouldn't mind owning it at this price, and you decide to start the wheel by selling a put. Sell one 90 put strike for $100 in premium. After you sold the 90 strike put, the stock tanked to 80, so you got assigned and received your $100 in premium. Therefore, you currently own the shares at $89 per share, including the premium. So essentially, you got to take the premium that you collected, subtract it from what you paid for the shares, and that becomes your adjusted cost basis. They're saying here's what you actually own the shares for. Then you sell a $100 strike call option for another $100 in premium. The next move you make is selling the covered call with a strike price above your $89 cost basis at the $100 strike. If you pick a strike price for the covered call below your cost basis, you could be forced to sell at a loss if you don't roll. Sure. After you sell the $100 strike call, the stock rises to $110 per share, and your shares are called away. The shares automatically get sold at the strike price of $100, and you keep the $100 in premium. Therefore, the trade generated a profit of $1,200. In addition, you made $1,000 from buying the shares at 90 and selling them for 100. Additionally, you collect a total of $200 in premium. So they're saying that the whole goal is just to make the put and call premium, but the share price appreciation, that's just like a bonus. But that's $1,000 of the monies in this particular example. I don't get it, guys. You sell puts and calls for premiums just to stay in the game long enough. Those are your little crumbs just to eat on a daily basis, on a weekly basis, on a monthly basis, so that you can make the big money, because there's a lot more money in, buying these shares at 90 in this example and selling them for, say, 180. So you want to stay in that game long enough to realize the big fat loaf of bread, guys. 3 things to know about the wheel strategy. Only trade a stock that you're willing to hold forever. In my case, I say 3 to 5 years, because that's how long it takes to get the adjusted cost basis to 0 on the stocks that I deal with. If you pick a stock only because it has high options premiums, you may feel inclined to sell at a loss if the stock price declines. Oatly. There was a company called Oatly that I don't know what I was thinking. If you do not want to pick individual stocks, you can utilize the wheel strategy on ETFs like SPY. Absolutely. Agree with that statement right there. Keep track of your cost basis. When you are selling options, you will collect a lot of options premiums. Therefore, you should keep track of all the premiums you collect and subtract them from your cost basis when you are assigned the shares. For example, if you sell a $100 strike put for 50 cents or $50 in premium and get assigned, you will own 100 shares at $99.50 per share instead of $100 per share. You must add the premiums you collect and subtract them from the price you own the shares to determine your actual cost basis. In this case, you would do 100 minus the 50 cents to get your cost basis of $99.50. I agree with this statement right here, even though I don't utilize it all the time. Only sell covered calls at or above your cost basis. I'm going to say that again. It's important, guys. If you're not going to be on top of your portfolio, you don't have a lot of experience rolling or anything of the sort, please listen to this again. Only sell covered calls at or above your cost basis. If you own shares of a stock at $99.50 and you sell a $90 strike call option, you risk selling the stock at a loss. However, if your stock is trading at a much lower price than your cost basis, it may be best to hold it until it goes higher. Or you need to have enough money to sell another cash secured put and average down, and then you can sell covered calls on 2 contracts now. So that's where the wheel deal is way different than your average wheeler, guys. Worst case, you can bite the bullet and accept that you may need to take a loss. However, if you are okay with holding the stock forever, you can be patient and wait for it to recover. You can definitely bag hold. That's a strategy, guys. Buy, hold, and hope. Nothing wrong with that whenever the stock goes against you. To start trading the wheel option strategy, you must find stocks that you can afford to trade. Since options require you to trade 100 shares at a time, you will be limited if you have a smaller trading account. Facts. For example, if you have a $5,000 trading account, you can only sell puts on a stock and ETFs that are $50 per share or less. You can get around this if you have a margin account, but as a beginner, it is best to stay away from leverage until you have more experience. I agree with that. And in fact, if you have a $5,000 trading account, guys, I wouldn't mess with the stock that's over $10. You won't have enough capital to run a rescue mission. Best stocks to wheel under $50 gives you some examples. As a reminder, this is not financial advice, and I am only providing these stocks to show you an example of companies that trade for less than $50 a share. Bank of America, Intel, the financial sector ETF, XLF, Coca-Cola, Kroger, Walgreens, Ford. I've wheeled Ford, I've wheeled Intel. A long time ago, I wheeled Coca-Cola as well. Bank of America, that's one that I'm definitely considering. We'll see. Bottom line, the wheel strategy. While the wheel strategy looks impressive in theory, there are always pros and cons to any system on the stock market. One of the downsides of the wheel strategy is when the stock you are trading increases in value rapidly. You roll. That's what you do. You will still make money when the stock moves up, but you would make more if you simply owned 100 shares of the stock. Let's say that again, because we're going to get rid of some myths today, guys. You will still make money when the stock moves up, but you would make more if you simply owned the shares of stock. That is not true. The only way that you would realize the gain is you would have to press the sell button. You would have to press the sell button. If you had a covered call at 100 and it goes to 130, it doesn't fucking matter if you didn't sell the shares for 130. You need to press the sell button to realize the gain. That's why there's so many people that are miseducating and misinforming people about the wheel strategy. That is not true. You don't realize any gains or any losses until you hit sell. That's why if you sell a covered call, it goes against you, it goes up in value, roll your position, increase your strike price, you collect more premium. Now you're padding the bottom line. I don't know what this person's smoking. Don't smoke what they're smoking, guys. Additionally, if you get assigned on a stock and it drops hard, you may not be able to sell covered calls above your cost basis. That is an absolute fact, guys. You will need to run a rescue mission. Additionally, let's read that again. If you get assigned on a stock and it drops hard, you may not be able to sell covered calls on your cost basis. And then it talks about understanding implied volatility. When you must understand implied volatility when trading options because it will determine how expensive options are trading for. And then it has a little ebook that you can download. I'll definitely pin this in the comments. There's a lot of valuable information here, but it's extremely surface knowledge, guys. It's very, very elementary, which is really good whenever you're getting into the wheel strategy. You're going to pick a stock that you want to own, sell, put, collect premium. You're going to do it over and over again until you get assigned, and then you're going to sell a covered call, hopefully above your cost basis. You're going to do that over and over and over again, collecting premiums until the shares get called away. But that's where most people stop. That's where I get started. The strategy for me is a little bit more in depth, a little bit different. The wheel deal strategy is pick a stock that I want to own, and then I'm going to sell puts at a price that I don't mind owning it. And I'm going to do that over and over and over and over again until I get assigned those shares. And then I'm going to sell covered calls at a strike price that I don't mind selling these shares. And I'm going to do that over and over and over again until I have those shares called away. However, what I'm also going to be doing simultaneously is I'm going to be selling more cash secured puts, and I'm going to be doing it over and over and over again, collecting that premium to lower my adjusted cost basis. And whenever I get assigned those shares, I'll be selling more covered calls, collecting more premiums to continue to lower my adjusted cost basis, because the real strategy is to own the shares with other people's money. I'm going to say that again. The wheel deal strategy is to own the shares with other people's money. So ultimately, if I want to have 100 shares of company XYZ, I may have to wheel 700 or 800 shares to aggressively lower my adjusted cost basis so the initial goal is achieved. So that's why you see me having 15,000 shares of Riot, 6,500 shares of Marathon, 15,500 shares of SoFi, because the original plan was to own an X amount of shares with other people's money. And then whenever that is achieved, then I will let some shares get called away intentionally, because now I'm playing with house money, guys. There's a lot more going on this channel than meets the eye. I'm not just wheeling stocks because I just I'm premium drunk and I like me some Riot, I like me some Marathon and stuff. Sometimes you see these positions and they're overly inflated. It's like a balloon. But eventually I'm going to pop that balloon. I'm going to realize some gains. I'm going to take some money off the table, and I'm going to play with the house's money, and I'm going to move on to another stock. What I haven't told y'all that yet is, what are those numbers? How many of those, because I'm trying to acquire 20,000 shares of SoFi, how many of those am I actually trying to keep to ride up to the promised land? Stay tuned, and I will give you that information probably 50 to 100 videos down the road. Same thing with Riot, same thing with Marathon. You guys have been following this channel, and y'all already know that I have 6,500 shares that are free and clear. I own these for like negative $2.24 right now. It's crazy. So anyway, good article. I recommend it. I think there's some valuable points that you can take into it, take from it. But it's just a starting point, guys. It's just a starting point. The wheel strategy is a lot like Texas Hold'em in poker. You can understand the strategy in about 3 to 5 minutes, but it takes a lifetime to master. And I'm still in the first or second quarter of understanding all the nuances of the wheel strategy. And I've been doing this for a hot minute at a pretty high level. But I'm always learning, guys. And don't forget to earn as you learn. I hope you guys have enjoyed this episode. This is TJ the Wheel Deal signing off. As always, may your sky stay blue and your stocks green. Peace out. God bless you guys.